Hi, everyone. Today we're happy to invite Rob Beardsley and Keshav Kalur. Keshav, you all know. Rob is the founder of Lone Star Capital. And Lone Star Capital has acquired over $350 million of multifamily properties in Texas and has provided over 23% annual returns for its investors. And in today's discussion, it's a fireside chat with someone who's been in the industry for 5 years and really made a name for himself in multifamily acquisition process. He's focused on underwriting debt and equity, and he's literally written the book on underwriting. So welcome, Rob, and welcome back, Keshav. With that, I'm just going to hand it off to you both and have you guys really discuss underwriting, the market, whatever is on your mind. And of course, with everyone here, feel free to raise your hands. Feel free to insert your questions in the question area. And then once we have a break, we will start answering questions that you might have. So with that, Rob and Keshav, take it away.
Great. Sounds good. Anything you want to add to the John's introduction?
Sure. Yeah. Pleasure to be here, everybody. Thanks for having me. Just to add a little context to my background, my business partner and I, we founded Lone Star Capital almost 5 years ago. We're here based in New York City, but we focus exclusively on Texas workforce housing, specifically Houston. We've acquired the majority of our property in Houston, but our focuses are Dallas and Houston. We also, last year in 2021, launched our own in-house property management business. So our entire portfolio is managed internally by our in-house team, and we actually just hired a construction manager to help us build out the some in-house construction competencies as well. So great to be here and looking forward to the chat.
Yeah. Well, thanks everyone for joining today. We're just gonna keep it pretty informal. Rob here's a expert on underwriting and acquisitions on the commercial multifamily value add side, I should say. We recently acquired 300 apartments together in Houston, so happy to partner on that, and hopefully it's the first of many. So I think we should kick it off by kind of talking about what we're seeing in the market today as we see these interest rates coming in, these interest rate hikes. We did get some relief, a little bit of relief yesterday with the CPI coming in a little less than expected. The market shot up because of it. How do you see the Fed moving forward and the effects of it on, let's say, residential real estate? We have a lot of single family investors and commercial.
Okay. Yeah. So, the residential is a little, definitely out of my expertise, but it is very connected to the multifamily space. So there's a lot of overlap. But, as we all know, there's been an aggressive regime change as far as interest rates are concerned, and that has led to a lot of changes in the capital markets. So specifically on the, in our business where we are, borrowers of fixed rate debt and a floating rate debt, we have experienced massive change in our availability of debt and the cost of it, which has forced us to pivot in the strategy. So, earlier in the year, we were borrowing at higher leverage because debt was freely available. The interest rates were very cheap, and incremental leverage was nearly free. If you look in contrast today, debt across the board is expensive, whether it's bank debt, agency financing, which is specific to multifamily, and then as well as bridge debt, which is kind of your transitional loan products that allow you to implement a business plan. Those were the loans that were kind of the hottest loans less than a year ago, and now those are almost unusable. Today, the interest rates on these higher leverage products are, approaching 8.5%, believe it or not, which is an unbelievable difference where you could actually borrow the same type of product and for less than 4%. So on the kind of the high leverage range, interest rates have doubled, and that causes huge change to your cash flow if you're already in a deal and it has a floating rate, as well as the way that we're looking at new opportunities. There's a a repricing that's slowly happening in the market. So the thing that's interesting is repricings don't happen overnight because sellers are stubborn, and we're all human, we're emotional people. So sellers have to go through an emotional process to adjust their expectations to lower prices. So we're seeing that. We're starting to get more phone calls and emails about so-called desperate sellers. And the reason why I call, do the air quotes is because today the sellers that are looking to sell are desperate to sell at their price. They're desperate to sell at a high price, but they're not really desperate to sell at the market clearing price. And that has led to a major disconnect between buyers and sellers today. We're just off. Sellers are sticking to yesterday's price. Buyers are forward looking at tomorrow's values. And that's about a 10% gap. So right now, we're just kind of, we're actively bidding, we're actively analyzing new opportunities, but there's this fundamental 10% bid-ask spread, which has to resolve itself by way of either easing interest rates, which allow buyers to then pay more, or sellers to come down in pricing expectation and to close that gap so that we can resume having a normal, healthy transaction market.
Thanks, Rob. That was very comprehensive, as always. And so with the market as it's changing, how would you recommend investors navigate it when they're hunting for their next deal, even maybe looking to exit current deals?
Yeah, it's a tough situation on both being a buyer and a seller. It's not a buyer's market. It's not a seller's market. I saw someone, I made a post on LinkedIn the other day talking about whether it's a buyer or seller's market, and someone just commented, it's a nobody's market, right? It's so specifically on the sell side, there's really just no motivation to sell for most people unless they have a maturity or some sort of risk that they need to move now for.
Okay.
Or if you're an owner today and you have a view that is more bearish than the market consensus, and you basically think this thing's gonna, things are gonna get worse before they get better, and I'm not gonna be able to withstand how worse it gets, so I just need to get out now. But most sellers don't really have that view. Most sellers don't have financial distress,
right,
let alone operational distress. So that's what's really interesting and unique about where we are right now, which could change. But all the issues that are happening, in our portfolio, in everyone else's portfolio, across the market, it's virtually only related to interest rates. I was analyzing the last few days. We've been analyzing our portfolio and working on all these things, and every single property that we have is ahead versus our underwriting projections.
Always good to hear.
Yeah, it's very good to hear. And so for people who, we're saying underwriting, and John kindly said that I, wrote the book on underwriting. So underwriting is just the financial analysis of acquisitions, of potential acquisitions. And so when I say that all of our properties are ahead of that is, when we buy a property, we create projections, and that's kind of like our roadmap for success. And we buy value add deals, like Keshav said, and that means that we add value to the property. We add income by increasing rents, by adding other income revenue generating items like washers and dryers, or a smart home tech package, or covered parking for other income. So all those things drive income, and that is reflected in our projections so that we are in the deal and we're trying to drive income higher. So anyway, yeah, that's why it's such a positive thing to hear that all of our properties are exceeding our pro forma. Essentially, we're exceeding projections, and that is not necessarily because we're the best managers in the world. We work hard, but it's really because the market is so strong. We have a kind of a paradoxical situation where rates are rising, and it's kind of causing things in the market that feel recessionary, but then at the asset level, we have record high collections, where we have record high rents. Everything is very positive at the property level. Now, one could argue that there's a lag effect, and that these rising rates are eventually going to permeate into the real economy, and that is what, and then in a year from now, we're going to feel the impact of that. And it is the Fed's goal to reduce demand and the only way to really reduce demand is to reduce jobs. And with reduced jobs, it would be very unrealistic for us to expect above trend rent growth in an environment like that where people are losing their jobs. With that being said, real estate is known as a good hedge. So, and we've been a very big beneficiary of all of this inflation happening that's been going to our rents. And we've been seeing very high rent growth. And even as expenses are growing as well due to inflation, we still come out ahead because rents make up usually around double our expenses. So even if they grow at the same rate, you're still actually coming out ahead. So that's kind of what it's like to be a seller and kind of see what's going on at the ground level. So it's hard to be a seller right now or an owner and look at your property, it's performing well, and go, yeah, I should sell for 15, 20% less than what I maybe could have gotten 6 months ago.
Yeah.
So that it's a tough environment as a seller. And then, as you know, similar but different story as a buyer. It's that gap. It's forward looking. We are limited by the debt options we have today. And quite frankly, when you plug in prevailing loan terms, if you plug in loan terms into your model today, it makes pretty much every deal not work.
Yeah, that's true. And so, I think you kind of underplayed how your assets are performing a little there, right? Being humble. Obviously, some part of it is the market, for sure. We've been on a tear since 2008, and things are cooling down a little. But I think some of it also speaks to how you are able, and you and the team here at Lone Star are able to underwrite.
Yes.
And obviously, that's one of your strengths, right, in the book that you mentioned. For our audience, when they're analyzing deals, what are some of the big things that you would recommend they keep an eye out for, whether they're active or passive? I guess the things that you look out for are the same.
Yeah.
But, maybe 3 to 5 things that really can make or break a deal that you want to make sure that you're being conservative with.
So, and I think, you've made a good point about property performance related to underwriting. And there's 2 factors there. On the one hand, if you have really conservative underwriting, right, so you don't shoot for aggressive projections, then it'll be that much easier to beat those projections.
Yeah.
Right?
Yeah.
So on the one hand, you could just say, well, just be really conservative. Then you're always beating projections. Right. But then if you have really conservative projections, the problem with that is your deal, your projected returns won't look exciting. And you'll have a really hard time. Me as a sponsor will have a really hard time raising capital from our investors if we go to them and we go, yeah, this deal's okay. It's probably going to do just average, maybe a little bit below, right? So it's hard. It's a very difficult balance as a sponsor to, on the one hand, want to be excited and confident and project strong returns so that our investors are excited. Yet at the same time, we don't want to overpromise and underdeliver, right?
Yeah.
So that is a really important dynamic that I think it's easy to get carried away when the market's really hot and everyone's buying deals and you have this fear of missing out. But at the core of our business, we have to provide, we have to underpromise and overdeliver from a return standpoint. We also have to provide great communication. So that's how we approach underwriting, right? So that's a little bit of tangent. But to address your question about what we look for in quality underwriting and what some of you, if that's what you're looking at doing as well, should look for in quality underwriting is, firstly, it's kind of going back to this concept is realistic rent projections. As my director of acquisitions likes to say, your pro forma rents is really a powerful button. The more you project, the higher pro forma rents you project, the returns just go up and up. It's a very sensitive input. If you change your budget, meaning you have to add an extra 100,000 here or there for renovations, it's not going to dramatically make or break your deal. But if you add $25 here or $50 there to your projected rents, that scales across, the 100, 200, 300 units across the property, and then that goes towards your bottom line and reflects in your projected valuation. So it has a major impact. So long story short, it's really important to get those rent projections right. And you have to do that through rent comps. And the unfortunate thing about this rule of thumb is that it's time consuming. It's hard to do rent comps. It requires some effort to look at sample properties and compare them apples to apples. But if you are, let's say, a passive investor looking to invest with a sponsor, I would certainly want to focus and ask them, can you show me your compelling rent comp argument for why this deal is good, for why we can hit the rents that we're projecting to hit? At the end of the day, there needs to be an argument or a justification for every assumption that is made, whether it be your projected rents, your projected expenses, your projected growth rates, your projected sale price. It's doable. It requires a little bit of work, but every assumption must be defensible. So I don't know how many of you here are kind of familiar with my world of multifamily investments, multifamily syndication, but a term that is thrown around way too much, and I think it's at this point hackneyed to death, is conservative underwriting. And it's an argument that a lot of sponsors will make, like, well, our underwriting is really conservative, and that's why you should invest with us. Which it's a good idea, but it's actually very difficult in practice. And that's why I kind of moved away from saying conservative underwriting, because how can you possibly be conservative in your underwriting when you're competing against a ton of other buyers and it's a hot market and everyone's fighting to overpay against each other? So you can't really afford to be conservative in that scenario. You have to be aggressive somewhere. So that's why I really like the term defensible underwriting. So I really encourage people to look at every assumption and say, okay, well, whether it's you wanting to defend your own assumptions or you are an investor looking to poke holes, putting the onus on the sponsor and saying, hey, can you defend these assumptions for me, please? Respectfully, of course. So number one I talked about was rent comps and your performer rents. Another popular one, which is a little bit more complex to understand, but that is your exit cap rate. Mm-hmm. And your exit cap rate is the multiple, essentially, on income that you use to project your projected sale price. So you buy the deal, you implement the business plan, you always need to sell the property at some point, and you have to decide at what price you're going to project to sell. And the way that in commercial real estate that is done, it's done through a cap rate, because by and large, property is valued on a cap rate basis. So the cap rates in your investment that are relevant are the cap rate that you're buying at, and then the cap rate that you're selling at. And then there's a third one in there, which is the market cap rate, because the cap rate that you're buying for doesn't necessarily reflect the market cap rate. There's many reasons for this. You could be, for example, buying a really good deal. Maybe your uncle is a seller and they're going to sell to you for a great discount, so you're actually able to buy for a higher cap rate than where the market is. That's obviously not a very realistic example. A more realistic example would be to buy a property that's underperforming. So the income is lower at the property because it's underperforming, but it has great potential. So in that case, a buyer like ourselves would be willing to pay more for the property on a cap rate basis, meaning lower cap rate, in the hopes of realizing that upside potential. And then when we talk about realizing that upside potential, we need to get upside in excess of the market. To put some numbers behind that, let's say we're in a market where the cap rate is 5% for the market. That means if you on average, if you buy a property, you'll be able to get 5% of the property's value in income every year. And if you buy a property that is underperforming, you might be buying a 4% cap rate with the hope of adding enough value to achieve a 6% cap rate. Because obviously we can't buy a 4 to then stabilize at 5, because what was the point of that? That's all this work to only end up at the market. We need to achieve greater than the market. So that is the premise of value add deals. And so that's what we look for. We look for properties where we can actually buy it and then create enough value to where we stabilize at a rate that's greater than the market to create real value. So that is, again, a little bit more of an advanced concept and number. That number is specifically referred to as yield on cost. And if that sounds interesting to you, I encourage you to maybe look up some articles, or you can check out my book on underwriting. to really dive into that topic more. But that is something that we spend a lot of time on.
Yeah. Okay, cool. Well, I mean, hopefully your new term, defensible underwriting, doesn't also get hackneyed to death too soon. Okay, that makes sense. Let's see. Hey, like we could take a quick break. Like, is there and check in on the audience? Any questions from anyone?
I had a question about funds. So I don't see on Lone Star Capital's website that Lone Star Capital offers funds. Could you enlighten us as to your thinking around funds and whether to go the fund route or maybe not go the fund route, and
Okay.
why?
Yeah. It's a great discussion. So we at Lone Star Capital, we don't offer investors any fund vehicles. We have thought about it, and we have something in the works, but by and large, we raise capital with our investors on a deal by deal basis. So every deal stands on its own, and that is more the norm. Funds are usually done by very large firms, and the reason for that is twofold. Large private equity firms, you take like a Blackstone, for example, the largest private equity firm in the world. They're raising, I don't know, a couple $100 million a week or something, right? They're just moving at such a scale that to raise capital on a deal by deal basis would be untenable. So when you achieve a certain size and track record and status where you're able to raise way more money than you can kind of reasonably just go deal by deal by, then you move towards a fund model. The other thing that's connected to that is when you have the level of track record, experience, reputation, like a Blackstone, you can readily raise blind pool funds. Whereas a firm like us, we would be making our lives harder by raising a fund because we wouldn't be able to show investors the deal. And by and large, most of our investors want to at least understand what the deal is, see some numbers behind it, and that concrete picture of the deal provides a lot of comfort to them, and it makes their investment decision easier. So that is kind of the balance on the fund side versus deal by deal side from our perspective, right? We would have to work harder to raise capital in a blind pool versus identified acquisitions. Now, from the investor perspective, the difference between deal by deal and fund is more interesting because really for the purpose of diversification. In private real estate investments and in really everything as a whole, achieving diversification can be pretty challenging. So if you look at our space where minimum investments are usually $50,000 to $100,000, to truly be diversified, it would require a lot of capital and a lot of work because you not only have to have the money to invest across multiple deals, multiple sponsors, because if you're talking about diversity, you'd hope to have sponsor diversity, geographic diversity, asset class diversity, strategy diversity. So there's just a ton, and that makes it really difficult to truly achieve. A lot of times we may think that we're diversified in what we're doing because we own some growth stocks and we own Bitcoin. But in reality, those are actually very correlated. And then same thing goes for real estate. We might think that, we own multifamily in Austin and we own it in Phoenix, but those markets are also largely correlated. There's less correlation in that, I would argue, than kind of things that are publicly traded, but I'm not an expert there. But the point being is, if you, as an LP, investing in funds can really offer diversification that is otherwise really difficult to attain, and that is the value. It saves you time. You write one check. It's simpler. So I think there is a lot of compelling reasons to invest in a fund. the downsides from an investor standpoint is, of course, it's a blind pool, so you cannot see what you are investing in. You are relying solely on the sponsor. So it removes your ability to kind of cherry pick the deals that you like and what you don't like. And then lastly, I'll throw in the idea that, usually if you're investing in a fund, again, it goes back to the concept, who's raising funds? It's usually people who have way too much money that they know what to do with. And at that level of scale, the sponsor is usually in a aggregation business where they just are looking to buy as many assets as possible, and they're being less discriminate about the quality of the deal. I don't mean to be disparaging to anybody, but that is just usually the reality. If you look at the data, emerging managers by and large outperform mega funds. So there is something to be said there about not parking your money with a mega fund, getting charged 1, 2, 3 layers of fees versus actually putting in the work to seek out direct investments in private, professionally managed private real estate. So that was kind of
that's great.
Pretty good.
I like that.
Yeah, thanks for the question.
I had a follow-up, which is a two-parter. One is multifamily, which is squarely what you're invested in, your Lone Star Capital is invested in, versus other commercial real estate asset classes, right? So especially in today's environment where it's competitive for multifamily, and there may be other asset classes that are a little bit more conservative. Granted, it's still competitive, like self-storage. It would be a great asset class if you could get into self-storage. It's very, very competitive. That's the first part. The second part is from a diversification perspective, that as well as Texas versus other regions. Lone Star Capital invests in Texas, and I know the answer to why Lone Star Capital has remained in Texas, but Texas versus other regions, I'd love to hear your perspective on that.
Great. Yeah. So firstly, as far as other asset classes, the darlings emerging out of COVID were 100% multifamily and industrial. And those markets were already hot, and then COVID exacerbated that trend and made them even more hot, especially because through the COVID situation, hospitality saw a big outflow of capital and retail saw a big outflow of capital. So that capital that is seeking commercial real estate yield flooded into industrial and multifamily. Oh, and also let's not forget about office, right? Capital certainly outflowed in office. So all that commercial real estate money now has been funneled into just multifamily and industrial, which has been great for values going up. So existing assets that you own have gone up in value and performance is great, all that stuff. But like you're saying, getting into new deals has been challenging. I mean, we're seeing the market change now, so we don't know how kind of value is going to move. But yeah, it's been very competitive and very tough because of that kind of focusing in on those asset classes. So that begs the question, well, if you are willing to be contrarian, think outside of the box, there are absolutely opportunities to get outsized returns in less favored asset classes. And again, it's kind of the favorites are industrial, multi, and then office, retail, hospitality are less favored. Hospitality has actually interestingly come back pretty strong. So that has been interesting to see, but I think at the end of the day, hospitality is the most pro-cyclical of all of the food groups. And that's because every morning your property is vacant. Essentially every morning you start at 0% occupancy and it's your job to fill it every single day. And the reason why it's pro-cyclical is because rents in hospitality are hotel daily rates. So as inflation goes up, you're able to adjust your rents every single day or adjust your hotel, your rental, your room rates every single day. So that's great in an up market and an inflationary market. But then if we do see demand reduction and job losses, you're going to see hospitality be the first one to drop and drop harder than things like workforce housing where people are renters by necessity. So I am concerned about hospitality. I wouldn't, and also, again, I need to stick to my knitting, which is Texas multifamily. So I'm not trying to give professional advice, but I would be cautious about jumping into hospitality today. But if I'm not sure exactly who I'm speaking to on this call, but if I'm speaking to potentially individual investors, I would look at strategies that are fundamentally harder for larger pools of capital to access, right? If you want to compete in multifamily, there's a lot of people with a lot of money, and people want to put that money out into big deals. So competing in that space is very difficult. But if you and your friends or a smaller pool of capital is looking for good deals, I would find deals that are smaller. I would find strategies that are smaller. Something that has been really successful lately has been Airbnb, short-term rental strategies.
Yeah.
Again, I'm a little bit nervous about those because of what may come as far as a recession, a softening in the economy. But at the end of the day, if you can buy, for example, a single-family home for its single-family home value, yet generate short-term rental returns, that's a huge arbitrage win. The problem that has happened in the short-term rental space, which I'm seeing with friends and peers that are in that business, is homes were getting bought for more than their single-family intrinsic value. They were being bought for their short-term rental value. So now you're paying more than the property's worth, banking on the upside or banking on the short-term rental. So if you do have a softening, your alternative is, let's say, a long-term rental, and the numbers are totally upside down. So yeah, I think that's kind of my high-level advice on that front is, finding things. If that is you and you want to focus on smaller things and you want to be active, you can find things that are harder for the big capital to access. You'll be able to generate outsized returns. Now, as far as Texas versus the rest of the country, I don't want to say that Texas is the best market in the country. Phoenix was the best market in the country until recently, because what happened was the growth was so incredible in Phoenix that it really didn't matter. I hate to say this because it really didn't matter almost what price you paid, because growth was going to bail you out. If you overpaid and you bought a really low cap rate, but just give it a few years and 20% rent growth a couple years in a row, and you've grown into your cap rate, no problem. But that low cap rate is also very interest rate sensitive, because all of a sudden seeing interest rates go from 3 to 6 plus, and you're looking at buying deals in Phoenix for a 2.5 cap to 3.5 cap, all of a sudden you're really whipsawed there. So I don't mean to single out Phoenix. It is a fantastic market, but you're seeing Phoenix getting just totally destroyed right now. Cap rates have expanded so much. It's been a major shock to the system because that market was wholly reliant on growth and low interest rates. Every market is subsidized by low interest rates, but when you couple that with high growth, it really exacerbates the situation there. So Texas, just for our own purposes, we really like it because for us personally, it's a large market, so we can spend a lot of time picking over a lot of deals. We like to be selective. We usually roughly acquire one property for every 100 that we bid on. So we're very active in the market, which I feel very strongly about because I want to have my finger on the pulse. I want to know the data. And I simply can't do that in Omaha, where there's only so many 100+ unit multifamily properties. So I like that there's so much of the product that we're chasing, which gives us a lot to underwrite and to learn the market. And other than that, we like Texas for the reasons you would like any market: strong job growth, strong population growth, landlord-friendly laws. What else? The negatives of Texas are that it's easy to build, and so it's not a supply-constrained market. The coasts benefit from being supply-constrained. But with that being said, the type of product that we target is usually 20 to 50-year-old properties. And so they are more insulated to the new supply that's coming online, because new properties are built to a luxury finish, catering to a completely different tenant base than what we cater to. New properties are being built, unless they are subsidized by the government, they're being built to the renter by choice. and we only rent to renters by necessity. So it gives us a little bit of insulation there. And by and large, if you look at our portfolio and you draw 5-mile radiuses from the properties that we own, there's very little new construction going on because they're fundamentally workforce housing submarkets. We're not downtown where there's new skyscrapers being built to compete with us.
Right. Thanks for that. Plus, it sounds like you're becoming more vertically integrated, which makes sense to stay in the same market.
That's right.
To leverage that.
Yes, that's totally a part of, like, focus, I would say, is one of our number one strategies, right? So we focus on the acquisition side, and then we also focus on the operations side, and we can create a strategic advantage through both fronts.
Great, thanks. We'll open this up to other questions, but Keisha, do you want to take it back?
Yeah, I mean, I'll give it like 30 seconds. I'm sure Rob's a little parched also, so I'll give it 30 seconds. We'll see if anyone has any questions. Well, one question I have for you, you started in 2018, right? So dropped out of Carnegie, going to multifamily. How did you get started analyzing deals, building that pipeline, building that relationship with brokers to the stage you're at now where you're buying 200 to 300 apartment buildings, once or twice a quarter? Like from 0 to 100, take us through that.
Well, when I first got started in the business, I naturally gravitated towards underwriting because I was having numbers mind and was in school for computer science. So that's where I naturally gravitated towards. I wanted to understand the business, and to me, that entailed understanding the numbers that drove the returns and underpinned the investment thesis. So I naturally gravitated towards underwriting, and there wasn't really any real resources out there that I could lean on too much to learn, which is in part why I wanted to write the book, to kind of provide that resource to people who want to really learn it. So I learned it on the job. I just started, kind of faking it till I made it, talking to brokers, being interested in buying property, not really having a way to buy the property yet, but that gave me deal flow, and I was able to analyze the deal flow, and the ways to really sharpen that was through getting feedback. As we started pursuing more deals, I would have an opportunity to discuss those opportunities with brokers, lenders, potential investors, and getting feedback from all those directions really sharpened our understanding and process to where we were able to iterate our underwriting model that we built, as well as our process, and that is how we developed that expertise. But to take it a step further, you can be an expert underwriter all you want. That doesn't necessarily mean that you're going to be able to close on deals and take it to the next step. So, that journey involved just kind of diving in. We put our first property under contract and had really no idea how we were going to raise the capital. We had no experience with borrowing that sort of institutional debt. So we really learned by doing. We dived in and had to make a ton of mistakes on the debt side and really struggle raising capital. We thought we would raise money from family and friends, which we did, but we quickly exhausted that network. So we had to reach out to a lot of people, ask for a lot of meetings, beg for money. And that was a good experience, but that experience taught me that I didn't want to be in that position.
Yeah.
So I learned my lesson there, and I was disabused of the myth that if you find a good deal, the money will come. And I soon realized that it really, of course you have to have a good deal, but it really starts with relationships first. And so from then on, I embarked on a multi-year journey, still going today, of building relationships every day with potential partners, potential investors, and that includes, as we discussed, publishing multiple books, being active in thought leadership, such as podcasts and webinars, and writing articles consistently, and things like that. And so that has done wonders to our business. And I'm so thankful that I learned that lesson early. And because when I first started, both my business partner and I, we started with this this idea that we just want to be real estate guys. Let's just do deals. Let's not worry about marketing and sales, and all that. And
you need it.
You need it. And I was glad I learned that lesson. And it's been working very well for us. We have many relationships to thank for it, which have allowed us to scale much faster.
Okay, cool. So a lot of rinse and repeat on like establishing deal flow, basically.
Yeah. Deal flow is critical, and that's, John, to your point, as another focus point. If you're trying to establish relationships with brokers and owners across the country, that effort's just going to be diluted across those many markets. But if you're focused in one place, you can really start to build relationships and get differentiated deal flow.
Is there any one aspect of your kind of the deal flow process that has elevated the deal flow that you're seeing? Is it webinars? Is it podcasts? Is it just the people that you meet, brokers and other people in the industry?
I would say that there is no magic there. The one thing I would say is, and as cliche as it sounds, doing what you say you're going to do. In our community of brokers and owners, your reputation is very important, and particularly to brokers who really are the gatekeepers to the transaction market. You want to be on their good side, and the way that we have done that is by being consistent and by doing what we say we're going to do. So if they send us a deal, we're going to be as prompt as possible in providing feedback, and we provide quality feedback. We don't just lowball and don't really justify our feedback. And then if we do put in an offer, we have to provide the brokers the confidence that we can execute on that offer and that we're not just throwing offers out willy-nilly. And so over time, we've been able to perform in that way. Exactly. So brokers, now we have built the reputation with brokers that we do perform, and that if we put in an offer, we can perform on that. And that just perpetuates itself to then getting more deals, right? Brokers want to work with us because they know that we're good to work with.
Got it. Okay.
Cool. How would you recommend, I guess, what are you guys doing? And then how would you recommend people navigate these next 6 to 12 months in the real estate market, right? People are always saying, I'm going to wait 6 months. Real estate always lags. Like you said, sellers are emotional. They're going to come down eventually. So I'm going to wait 6 months. Interest rates will keep going up, and I'll just kind of get in, right near the bottom.
Yeah. The reality is it's a lot harder to predict the market than people think, right? People think that they can time the market, but it's actually very, very difficult. So, we're in the business of doing deals. So, firstly, we are every day analyzing our existing assets and looking at ways that we can optimize the situation. Obviously, rising rates across your portfolio is not a good situation. So how do we best handle it? And so we're looking at refinances, we're looking at pivoting our business plans and things like that. So that's first thing. And then second thing, moving forward for new acquisitions, we are in the business of doing deals. So we're putting out offers every day and looking for new opportunity, but we have to be reactive to the market. And right now, the market is not really providing us opportunities. So while we'd like to buy new deals, we're pretty limited. So with that being, I think, like, to your point, taking an extreme position of, hey, I'm just going to take 6 months off or a year off and come back, for us, it's not feasible. We need to be in the market. We need to be getting that feedback. As an investor, if that's your strategy, you can absolutely do that. Me personally, as an investor, I just invest in my own deals consistently. I invest in the stock market fairly consistently. I don't try to time the stock market. I just buy in roughly quarterly intervals, because it's just the reality. Like I said, it's just really hard to time the market. So The other consideration for investors, I know we've talked about, are the tax implications of investing.
Mhm.
So, we have plenty of investors who are seeking depreciation, which is thrown off by our investments, especially when it comes to the end of the year. People start to scramble to make sure they have enough of it. So we're seeing investors come in and invest with us for year end. So yeah, that's every investor has their own strategy, their own risk tolerance, and the other thing to think about is what is your outlook. The longer your time horizon, the lower the risk. So if you buy a deal today, like we've talked about, it is likely that property will be worth less 6 months from now.
Yeah.
Maybe a year from now. We don't know the exact bottom. We don't know what that's going to look like. But just because your property goes down in notional value doesn't necessarily have anything to do with the property's performance, the cash flow, or the eventual price that you sell it for. So having the patience to identify good opportunities and then being willing to withstand maybe a period of declining valuations and then to wait for it to rebound, that definitely takes some skill, but I think that is a better way to approach rather than trying to time the bottom.
Yeah. Okay. And you brought up a good point about taxes, right? We know that but bonus depreciation right now it's 100%. It's been that way for a few years, and that's got a lot of people piled in to real estate. But that's going to go down to 80% next year. It's going to keep going bad, 20% until the sun sets, unless lawmakers do something about it.
Right.
How do you see that affecting deals, investor demand, the market in general?
Yeah. So bonus depreciation has been a really big win for commercial real estate investors, and it has spurred transaction activity. As a seller, you know that if you sell your property, you're going to have a capital gain to deal with. However, with bonus depreciation, you can reinvest your sale proceeds and get a ton of depreciation to offset those gains. So that, in effect, is very similar to a 1031 exchange, where you can sell, buy, defer taxes. With bonus depreciation going away, that ability to defer the capital gains is going to go away. So that's going to make sellers think harder about selling. So that's going to slow down transaction activity and also going to increase the importance and value and frequency of 1031 exchanges. So 1031 exchanges are one of the most fantastic tax strategies available in real estate and in general. And people have been somewhat getting away from it because they're thinking, well, I can just get the depreciation, no big deal.
Yeah.
So we are actually experts in 1031 exchange. We facilitate a lot of exchanges for our investors. We also do 1031 exchanges at the entity level. So when we acquire a property with our investors, when we eventually sell that property, we then 1031 exchange that entire LLC into a new investment. So our investors that are investing alongside us, they can elect to either take their funds in cash or roll it over with really no cost or work to them into the new property. So that allows investors to passively defer capital gains and create a snowball effect and compounding wealth. So I think 1031s will get even more important and valuable coming up.
Okay, cool. Let's see.
Any other questions from anybody listening in?
Just to follow up on the 1031 exchange, my understanding, and this is a really rudimentary understanding, was that it was difficult for LPs to actually, and for that matter, sponsors to participate in 1031s. Was that primarily because of the fact that there are periods where you have to find the property, you have to then sell your property and then roll that monies into that new property, or was it because of just some limitations in terms of entity structure and just operationally, like how it can be done?
So 1031s are always fairly difficult to pull off because of the timing that you mentioned. You have 45 days to identify the replacement property upon sale, and then you have 180 days from sale to close on that replacement property. you can identify 3 different properties, so you can have some flexibility. But yeah, you need to definitely get the timing right, and that's true in any scenario. The complications are even greater when you have a LP GP structure, and also kind of a related situation is when an investor 1031 exchanges, let's say, a rental property that they own, and then they exchange the proceeds from that sale into one of our investments. So we actually accept those sorts of exchanges where someone can go from actively owning a rental property to then now exchanging those funds and then passively owning an interest in one of our larger, professionally managed multifamily properties. And that is a very complicated scenario where we have to navigate the relationship between the lender, the 1031 exchange investor, and us, and make sure that all parties are happy. As far as entity level exchanges, they're really not that challenging. Like on the investor side, the LP side, investors don't have to do anything. They can just roll over the funds with the entity exchange. It's on us to identify the replacement property and execute the 1031 exchange. The hiccup that you may also be familiar with or referring to is the idea that LPs cannot 1031 exchange on their own. And that is because technically limited partners don't own the real estate that they're invested in directly. They own a partnership interest. And so a partnership interest is not eligible for 1031 exchange. You can only 1031 exchange real property. So that is a hang up and an issue if an investor is looking to invest as an LP in a deal and then take their proceeds on their own and go exchange it. That requires a different structure called a tenancy in common, which is how we facilitate exchanges into our deals. So there's definitely some wrinkles there, but all very doable if you're willing to roll up your sleeves.
Thanks for that. We are coming up at the bottom of the hour, but I want to drop some links, and maybe Rob, you can drop your contact information in here. Here's a link to the Lone Star Capital website, right? And then Rob just dropped a contact link to Lone Star Capital and his email. Any other questions, final questions before we wrap up? All right, we'll call it. Thank you very much, Rob, for participating in today's fireside chat, and thank you, Keisha, of course, for helping facilitate that. We wish you the best of luck. Do you want to talk a little bit about that office you're in?
Sure. Yeah, we just moved in to our new office space here at One World Trade. So really excited about that. It's been a long time coming. We've been kind of scrappy working in various parts of the city, including my old apartment building. And we've wanted an office for a long time. We're big believers in the office. We don't buy this whole remote work thing. So we all like to be together and enjoy working in the office. So yeah, it's good. It's good to be here, live. And we just moved in a couple weeks ago. So as you can see behind me, we have makeshift desks for now. But I'm really looking forward to being fully furnished and maybe welcoming one of you guys as a guest soon.
Very good. Well, thank you very much for the time. And of course, this will be recorded. If anyone has any additional questions or comments, feel free to come back to the Gather page. And thank you again to the both of you.
Yeah.
Have a good day.
Thanks, Rob, for coming in, and thank you everyone for tuning in, and have a good weekend.
Thanks, guys.
Thanks.
Bye-bye.
Bye.